Hello, everyone. Welcome to an Options Income Blueprint weekly income report live on May 2nd, 2022 with Michael Schulman. My name's Emily Norris with Traders Reserve. We're going to be going over our results from last week. We're also going to be covering a training topic and, of course, the upcoming Fed meeting this week. If you have any questions throughout the session, feel free to pop those in the Q&A box. We'll get to those once Michael's wrapped up with his presentation. We are recording this session. We'll be posting it to the member website as well as sending it to you in email form. With that, I'll let you take it away, Michael.
Thank you, Emily. Just sort of repeating what Emily just said. If you're brand new to Options Income Blueprint, I know a few may be, or you may have dropped in the last couple of weeks. If you dropped in the last couple of weeks, wasn't April a fun month? The one thing I promise, because I got an email about this, and I sort of got my backup. There was the whole thing of cash returns versus portfolio value, and many of our open positions are underwater. My portfolio is getting hit. What are you talking about in terms of your cash returns? So it's not in this presentation. I've done this too many times in the update, but I want to repeat. We have a cash focused service because the last 10 or 11 years, well, 10 and a half years, we've gone through 7 corrections and a crash. And cash generation on a weekly basis over time always has in the past, and I'm assuming past is prologue, has overcome downturns in the market. So I'm not suggesting this is going to happen, but if at the end of the year, we do 25% in cash and the market is down 20% and so forth and so on, we'll be ahead of the game if things work out properly. And I'm just saying that not to be defensive, but I'm trying to get people to get into the groove of understanding things take time. In fact, you should look at or read or listen to part of the Berkshire Hathaway annual meeting, which was broadcast for the first time this weekend. And now it's a funny term, nonagerians, that meaning they're in their 90s, Buffett and Charlie Munger. Munger's older than him. But how they keep on reminding people they can't predict inflation, they can't predict the market, and so forth and so on. We're going to try here a little bit today to predict what's going on because we do trade weekly. But a little dose of a little Berkshire wisdom wouldn't be a bad thing either. So last week, we only closed one trade. We were in and out in a hurry. Very nice profit and nice rate of return. There will be much more of the same in terms of getting in and out more quickly than, let's say, we did 6 months ago because of the nature of volatility in the market. But we also, we sold some calls. We sold puts. Again, this is this focus on cash based on an underlying capital base. So we traded GM twice. We traded Delta once. You can see the cash and the rates of return that were coming in. And you can see we're still hovering around our cash goal of 26% a year since we started doing these updates and sharing this day-to-day data with you. And that $40,000 is a guideline, by the way. We've been above that goal of 26%. And it's not in a volatile market. It's not worth calculating on a week-to-week basis. It's something that I calculate, and you should every quarter. But from a cash focus point of view, we're doing fine. And there's the overall performance of the new trades. Potential net of return is 2%, or the rate of return is 2%, and calls on shares. So there's a mix. Now, the other email I got was this was not from this service, but I think it's worth sharing with someone who came in. I didn't know that you accepted shares. This sounds like someone who was using margin for puts, because margin is much more generous for puts than for shares. And if you're fully margined with puts, you accept shares, you can be in a world of hurt. And I've heard this face to face in Florida. I heard this face to face in Las Vegas, so forth and so on. It's not my concern. How you allocate capital and use margin is your own affair. And I don't mean to sound cold-hearted or indifferent. I can't really do what I do on your behalf as well as I can, as best as I can, with margin concerns. And more, owning shares and selling calls makes sense because you can capture appreciation and cash at the same time if and when the stock rebounds. So, but let's get to the Fed meeting, which has slowed down some of the things we're going to do. It may mean tomorrow, depending on the market, we may just discuss. We may not even put on a new trade. It might not be prudent. And I may wait until Thursday morning and do it via alert. Not sure. There are things that may go up or independent of what the market does. The travel sector looks like this might happen as well. So rate hikes are obviously a given. The question, of course, is what will they look like? And a 0.25%, which was the stated intent of the Fed to do this 6 times after every meeting, is increased. It seems unlikely now because of the hints that Federal Reserve Board governors have been dropping, and they do that to warn the market, to warn the bond market, to let people start changing positions. So it's unlikely. This would actually impact the bond market in a positive way. I think a half-point price hike, which we'll get to in a minute, interest rate hike, is pretty much priced in. And equities would spike short term. Now, 0.5% is now the most likely. I wouldn't have said that 2 months ago. The question, of course, is how is it going to hit the bond market? How many interest rate doves? Is it 1% of the bond market, 5% of the bond market, 25% of the bond market are trading bonds as if there'll only be a quarter point hike? And how many are trading as if there'll be a 3/4 of a point hike or a half point hike? And the bond market now is forecasting, depending upon which guru you follow, 6 rate hikes, at least half will be half a point. I have to follow somebody since I'm not a bond market watcher. And I have no opinion right now. I'm concerned with equities and what will happen. Since this is the most likely, I think the most likely scenario for 0.5% is a sell-off that quickly corrects itself. But that doesn't mean the sell-off won't continue, but it won't be from the bond market. It may be because of Ukraine. It may be because of supply chain issues. It may be because of companies forecasting that they're not going to make their number, or they'll have a reduced number for the rest of the year because of Ukraine and supply chain issues. And I think 0.75% is highly unlikely. It would create an enormous, gigantic, massive hit to the bond market. And the market sell-off would be huge. It would really be large. Because when you look at current interest rates, it would look like a doubling. And it's just something that it's hard to imagine the Fed would hit the markets with. Why do I say the markets and not the economy in a minute? The wording may be more important, especially if we get a 0.5% hike. So now if we get a 1/4% hike and they say they're on track for 1/4%, in my humble opinion, based on the people I read, I would expect a rally in bonds and a rally in equities. Could there be fewer but larger hikes, meaning doing 4 0.5% rate hike? We don't know, but the wording will be very important. I am prognosticating as opposed to guessing. It's a fancier word, so has more impact. That they'll say they're on track for 6 rate hikes. They're uncertain if more than this one will be 0.5%. It depends on market conditions. And that goes back to this, is how many doves and hawks are in the market that will drive bond prices. And for those of you brand new to this, when the bond markets get hit, equities get hit because people readjust their portfolios. So when existing bonds get hit and money flows into the bond market because interest rates are going up on new issues, or older bonds, of course, adjust to that, and you can buy them at less than face value, then that money comes from equities. So why the confusion? And this is important to our trading individual stocks, so I'll spend a little bit of time on this. Will interest rate hikes slow inflation? I was asked this question at who asked me this question? Was it breakfast? We have a group breakfast. Was it dinner? I think it was a dinner. I was trying to think of the person who asked me. And it was someone not in the labor market. It was a retiree. Anyway, what's causing inflation? Rising energy prices. Fed can't do anything about them. Rising food prices, in part because of rising energy prices. Fed can't do anything about that. Those aren't part of the core CPI anyway. Raising product prices because of supply chain issues. Fed can't do anything about that. Rising housing prices because of lack of inventory. Nope, can't do anything about that. A tight auto market with everything selling at full list and used cars selling for $6,000 or more than they were last year. Fed can't do anything about that. Those are the big components from the old-fashioned view of the economy, housing and cars. Fed can't do a thing, not unless you really jack rates up, which they won't do. I mean, I'm talking 3, 4, 5 points, not half points. Can't affect food, can't affect energy. My belief is the Fed is raising rates to maintain its own institutional credibility, and to, over time, put a brake on the psychology of inflation. But a half point increase on a credit card with 14.9% interest rate, or even a 9.9% interest rate, a half point increase is not going to change anybody's spending habits. And I think the Fed knows this. So I think their interest rate increases are about building the United States back to a place where we have positive real interest rates, meaning right now, real interest rates are the nominal rate minus inflation. Right now, we have negative interest rates we've had for several years. So will interest rates hit the economy too hard? Haven't laid a glove on the economy. Does Ukraine matter? Oh, yeah, especially food, but to a lesser extent, energy, and there will be a recession, probably a pretty nasty one in Europe. For those of you who weren't in one of my previous trading sessions, I had the privilege about 3, 4 weeks ago, I belonged to a group of people, get together, 50 people, 40 people, 30 people, wine, cheese, and a topic, 5 or 6 times a year on a Saturday night. And we were fortunate someone knew the ambassador from the Czech Republic. And brilliant man, really, really, really effective speaker, especially in a small group in someone's home. And he predicted everything that is currently going on the ground in Ukraine. And he also said there's going to be a severe recession in Europe because of energy prices. And this morning, the news broke, maybe last night, that the Germans, because of public pressure, are accelerating their getting past the energy umbilical cord that Angela Merkel built between Russia and Germany. They went from 35 to 65% dependence on Russian fossil fuels. And they're going to take a recession in the United States. Washington Post, ABC poll. 2/3 of Americans are concerned about gasoline prices and food prices in particular, but 2/3 of Americans say they completely agree with what's going on in administration policy. So the public is caught. They don't want inflation, but it's some people, the public, understand what's happening. And so the question is, how fast should the Fed get to 3% interest rates with the backdrop of Ukraine, China's supply chain issues, and so forth and so on? And it depends upon your view of everything that's going on. So to that point, we've discussed the Fed, and you're looking at market volatility that has gone from, occasional 1% to 1.25% day to 1.5% ups or downs to 3%, a little smidge under 3, like we saw on Friday. And that can make anybody nervous. It can make people trade haphazardly. I'm going to talk a little bit about getting back to basics without being too pedagogical. If you're in the Income Masters program and you have not gone through the 6-figure portfolio coaching program, which I'm lobbying, by the way, John and Dave, our publishers, to offer as an independent program again. We haven't done it in a while independently. We might do it this summer. You have to get back to basics. It's the only way to get through these markets other than going cash, which I don't recommend. So use a decision tree. Do I see a trend? I'm getting back to basics here. Is this company good or the greatest? Do I like the stock? Do I like the chains? Do I want to trade or own it? How do I want to trade it, own or rent? John Hutchinson came with the term rent. I like it very, very, very much. And you want to capture the cash. This only happens if you view everything as a position that could last for weeks, perhaps months. The core stocks that we have, it's months. And you're focusing on cash. If you focus on your portfolio value every Friday, you're going to lose your mind. Unless you're a day trader. And we don't do day trading. So, oops, excuse me. I always hit the wrong button. So let's get back to basics. Trend, what's going on in the real world? Company, which are the companies that are going to outperform their peer group within the trend? Which of these stocks are undervalued or occasionally will trade something that I see fairly valued? What does the chart look like? Is it tradable at this point in time? What do the chains look like? Are they liquid? And not just for this week, but can I roll the position week after week if I want to? And the premium. does it enable me to hit my goals? So I want to do this and walk through the trade from last week, which is Delta Airlines. The trend is Americans are traveling big time. When I was in Rome, just by happenstance, I met mostly with freelance financial reporters and a couple of business executives. In addition to eating a lot of pasta, I'm very proud to say I had 10 pasta meals in 7 days and didn't gain any weight because I was walking between 8 and 11 miles a day. But um, I'm not bragging. It's the only place in the world I ever do anything like that. But I sat next to 3 women who were in the travel business. One was in travel business, the other 2 are in medical devices. And we had a really long conversation, and she validated in Europe what was going on in the United States, which is Americans have canceled a lot of trips to Europe because a lot of Americans, given the quality of American education on geography, think that Ukraine is next to Italy or Germany. and have canceled European trips, but have doubled up on what's going on in the United States. And I check hotel prices and airline prices every Friday. And the trend is absolutely Americans are on the road, big time. Despite gasoline prices, it's still cheaper because airline prices have spiked. My business class ticket to Rome, which I purchased last November, I checked, is now more than double that price. So the company really put out an excellent 2022 forecast. Now, Delta is not the purest play on domestic travel. JetBlue and Southwest would be better, but Delta's announced, I knew what their forecast was. I read the transcript. They have very transparent financials. They protected their balance sheet better than United and American during the pandemic. And they have a lot of upside, especially if things in Asia open up more because they have a significant exposure to Asia. So the stock was fairly valued. I don't consider it to be undervalued. It's possibly overvalued, which means I need to think about how I'm going to trade this. There's visible support in the stock after earnings. The chains were liquid enough, not super liquid, but liquid enough. They're tradable. We've traded, and the premium was excellent. So there was the 20-day chart, and you could see we had support at 40. That you have up here, you have this move up from earnings, and then this might have been a short squeeze, and some people jumped in and traded it, and now we're selling off. The market was sharply selling off, but then we found stability over here, and it's going back up again, independent in many ways of the market. It traded against the market. It was not correlated to the market the last few days before we put this trade on. So this was the alert. All the numbers are there. If you traded it, you know what I'm talking about. So the original target, and this is the important part, was a 73% annualized return. For those of you who just showed up, all positions that I evaluate are based on annualized returns, not absolute returns or cash. And in the training materials, they'll show you what the calculation is. It's second grade, maybe first grade math. And so the goal was the 32% annualized return as the threshold level of putting on a new position, with some exceptions, in options income blueprint. And this was all, and the premium was very acceptable. So we closed it early the next day. And why did we do it? Well, the stock kept bouncing. Remember, it was at 41.95, and we saw 40 to 41 as support, but all of the traders did as well. I mean, it's not like you and I are the only people watching a chart. And so it bounced off of it. The stock price was up over $1 from where we traded it, which is almost 3%, 2.5%, 3%. But more importantly, we hit our goal by closing for a dime. And it's actually an important number for some of you, which I'll discuss in a minute. And we had a very nice profit, and the annualized return went up. Why? Because when you do the calculation, it's the amount of time you're in the position in addition to the amount of profit you make. But the 10 cents is not the reason I did the trade at 10, but it's important. Many of you, I hope all of you are brokers where a trade to buy something back for a nickel is free. There's no commission. And some of you at 10 cents, there's no commission or a very reduced commission. So here was the math. Emily and I are sort of trapped, glued, adhering to our computers, but we're busy. And I have alerts on, but the alerts are on stock prices as opposed to option prices. So we're always going in and out and seeing if it's time to close. And this time we went in and out. I think Emily caught this one and sent me a text and said, bingo, we're there. I think it's time to go. And she was correct. So going forward, with that trade in mind, with getting back to basics in mind, the question now I want to talk about is renting or owning. When there's a stock that I see to be fairly valued or overvalued, like Trade Desk, when we trade it, is a radically volatile, overvalued stock by any metric, except the way it's traded since its IPO, which is actually a legitimate metric to trade the stock for 3 or 4 days. And with silly puts in the case of Trade Desk. So when you're looking at overvalued or fairly valued stocks, which I think Delta falls into that category, I'm looking at support levels and ceilings. And I saw us comfortably trading at nearing a support level and finding stability with volume coming in and so forth and so on. You want to own a stock, and own, by the way, is either owning the shares and selling calls or selling puts every single week. Now, our 4 core stocks are radical. Well, General Motors is ridiculously undervalued. Pfizer is absurdly undervalued. It doesn't give you solace if you're underwater on the position, but it surely makes me comfortable. Citigroup is undervalued based on the upside potential, although its exposure to Europe makes some things problematic. And Marvel is undervalued. So that's why they're core stocks. Pfizer's trading at a 75% discount to the S&P 500. Given its growth, it may even be more than a discount. General Motors, the thought that Tesla is worth more than I think GM and Toyota put together is one of the funniest things I've seen in the stock market since I started following stocks a long time ago. There's an absurdity about Tesla's valuation, and it's linked to hype and hope and Elon Musk and all that sort of stuff. And we don't do hope and hype. We do fundamentals. One important line, 2 important lines, you do the math, second grade math, and please don't be greedy. That's it. A little heavy-handed here, telling you, how to pick your stocks and run your portfolio. But it's extremely important to know that even at times like this, you do fundamentals first. And the flip side of that is you're willing to close something in a day. You hit your goal. So the 2 sets of fundamentals, and maybe I'll discuss this at a later date, is the fundamentals of how you construct your portfolio, which is you have to have goals. The goals have to translate in how you trade and how you find positions and so forth and so on. You can't just look for stocks, and you can't just say, I'm going to do this with my portfolio. You have to marry the 2 every time you put a trade on. With that, I will, one last thing. If you haven't checked your email, a bunch of alerts went out about closing our 4 positions where we own shares. We're closing Pfizer, Lyft, Bank of America, and Citigroup are selling the shares in anticipation of the Fed meeting. Not a time to be in those positions. I'll turn it back to Emily now.
All right, Michael. Let's see. We have a question from Chris. Looks like resistance level on SPX is in the 4,100 to 4,150 area. We've been bouncing off that level several times. We've bounced off that level several times recently. If it does get breached decisively to the downside, does that then trigger the algorithmic, i.e. automatic selling, which would drive it even lower? It looks like the next resistance level would be around 3,800. Ouch. Is this the correct analysis? What is the likelihood something like this could happen, especially if the Fed throws us a curveball?
If the thread throws a negative curveball, support, I'm close. It's 3850, 3875. Algorithmic trading is now 85. It's always been 85% of the market. It may be 90 right now. And it's one of the reasons we're getting some very strange things happening. And there's algorithmic trading of people who trade the indexes. And I think on a volume basis over a period of time, meaning more than a couple of hours, you have a lot of algorithmic trading related to portfolio adjustments. So there are a lot of professionally managed pension funds, hedge funds, investment funds, mutual funds, whatever, where if you get an increase in interest rates, there's an automatic selling of equities and rebalancing with bonds. It happens automatically. There are hedge funds that trade off of headlines on press releases. And if the press release is wrong, they get it wrong. I'm not kidding. I know I'm taking a sideline, and I'm not name dropping. It's a very funny story. When Gore v. Bush, for those of you old enough to remember the Gore v. Bush Supreme Court case, the ABC legal correspondent at the time was Jeffrey Toobin, and he grabbed the decision out of my wife's producer's hands. My wife is a Supreme Court reporter at the time for ABC. She had a copy, her producer had it, Jeffrey read it. It was a poorly worded decision. And he said that Gore won in the case. When my wife was asked what happened by Peter Jennings, she said, I don't know. And the funny part of that is because she said, I don't know, Don Imus, the DJ, named a cow after her on his farm, as well as Cokie Roberts and Andrea Mitchell and whatever. So she was in good company. But the point is, I don't know is really the answer here, in that it really depends on what's going on with people watching the Fed and turning that into how they're playing bonds. And to the extent that people don't play bonds and play equities, but they're professionals, they've set everything up about anticipating the Fed will hit interest rates will hit bonds. How do I respond with my equity portfolio? And that's why there's confusion. It's very difficult. Right now, the bond market is priced in more aggressive rate hikes than the stated Federal Reserve intent. Meaning that there are people who do analysis and publish it. You can Google it. What is the bond market pricing in for interest rate hikes? And right now, the Fed has 6 quarter-point increases. The bond market is pricing in the equivalent of, I think, 7, and I think 1 or 2 of those would be half points. So it's actually priced in terms of the way they price Treasury futures, and Treasury bonds. They priced in something more aggressive than the Fed states. So to your point, what's worst case? Worst case is the Fed said, we're going to raise a half a point, not a quarter of a point, for as long as we can think. That would be a hemorrhage. And we're at basic support levels, but frankly, those support levels don't matter in the face of such an important Fed announcement. I think that's why you asked the question. If it's a ho-hum announcement, which I think it might be, which is we're going to do our 6 increases this quarter, we're going to do a half. We'll see what we do next time, depending upon economic conditions. It'll probably sell off a little, but then, to your scenario, you might see support kick in at 4,100 or 4,000. By the way, for those of you who are new to this, when we talk about support of 4,100, we don't mean we're not going to go to 4050. It means we might go to 4050 for 3 hours or half a day or a day, and then we'll come back to 4,100. So it's a support level within a certain period of trading time. But right now, implied volatility in S&P options is off the charts. And I was telling Emily before we started, if I read correctly, I may have gotten a little bit wrong. The volatility is 43% away from the mean, which implies extraordinary movements in the option chains, not the indexes, should something untoward happen in either direction. But it's a good question. I don't know. I'm not an index trader, but I think the scenarios are half point is likely, conservative language about a possibility of a half point in the next 1 or 2 announcements. And if that is stated with the typical guarded language, I think you'll have a little bit of a sell-off, and then 4,100 may kick in for support.
All right, Michael, Rick says, seems to me we have more in common with the landlord than the renter. We receive cash weekly, don't even have to own the property or asset. Very benefited landlord.
Sure. With the core stocks in particular, that's true. The reason I specified own and rent, we're going to be doing more rent trades given market conditions because we have so many positions where we own shares and we're not going to be getting out of for a while. So I'm not looking at adding something that I want to trade for 6 months. I don't want to trade the airlines for 6 months. I don't want to trade hotels for 6 months. I don't want to trade software for 6 months, and so forth and so on. But you raise a very good point. Right now, between the core stocks and stocks that were underwater that we accepted shares, in Bank of America being an example, we're owning. And right now, if it's an undervalued stock, and the 4 companies, Lyft being they're undervalued. Lyft is undervalued based on historical metrics of the way it trades, not price earnings multiple. That's true for Sunrun as well. So I have to be careful in how I use the term undervalued and whether historical norms on trading matter. If historical norms mattered, for example, on Pfizer, it would be $150 to $175 stock. I'm serious. And General Motors would be about 80 or 90. So what happens is history can be rewritten. So if they continue to trade nearer at current levels for another 6 months, there's a new multiple that you would assign to those as the more typical multiple. But it's a good question you ask, and I think there was a column by Stephen Sears and Barron's to the point, and he covers the trader. It's, different trades every week. And he was talking about selling calls as a way to protect oneself or benefit from a down market.
Okay, Michael, we don't have any other questions at the moment.
Okay. I'll talk a little bit more. We're going to do trading tomorrow. There's a 50% chance we won't actually put a trade on. I'm going to be scouring and looking around for either a silly put that would stand a market downturn, or because I think there's only a wee, as the Scots would say, a wee possibility of a major sell-off. Famous last words, right? But so it's about a half. I think there's this 50, maybe less than 50% chance we wouldn't trade. We would just discuss at length all the open positions and what we'll do with them after the Fed meeting. And the Fed meeting notes the announcement, the press release is usually 2:00 on Wednesday. So after that, meaning Thursday morning, they'll probably, Thursday and Friday, there'll probably be a series of alerts about the positions that we have.
Okay, Michael, we did get another question. Susan says, I'm new to the service, but it seems to me that the premiums are minuscule. It's difficult to make money unless I trade at least 5 to 6 contracts.
It's rate of return. If you're a regular options trader looking for home run, you landed in the wrong place. Sorry, I'm not going to be shy. We try to get 0.5% a week, and that's just the way it is. If you have a small portfolio and you're looking to do 100% a year, that's not us. The idea is to just nail a 0.5% to 1% a week on a specific trade or position, with a focus on cash, not on the short-term underlying capital value. And that's just what we do. There's nothing wrong when you're putting up $4,000 and $4,100 in capital on Delta, or $4,000 in capital, of making a $22 profit. If you make a $22 profit on Delta every single week, then you have a 27, 28, 29% return. And if you do it on an annualized basis, the way Wall Street does it, which is calculate days, because Wall Street manages its capital 24/7. A big firm is trading 7 days a week in different markets. If we went back to the way we used to measure things 10 years ago, which was one trade a week, even at one trade a week, you have a 25 to 30% return on Delta. So that's, just what we do here. And that's just the way it is. I mean, and a lot depends on the size, of your portfolio. And portfolio advice is never get overcommitted to one position, obviously. And if you have to trade 1 or 2 contracts, you trade 2 contracts on Delta, you put up $8,000, you can end up with a $2,000, $3,000 profit, $2,500 profit at the end of the year. I think that's pretty good.
All right, Michael, that's it for questions.
Thank you all, and I'll see you tomorrow, live trading.
All right. Thanks, Michael. Thanks, everyone, for joining us. We have recorded this session. We'll be posting it to the member website as well as emailing it to you. I've posted a link to the May schedule in the chat box. It's also on the website. Just be sure to click the registration link for live trading. It's just one link for all of this month's sessions, with the first one being tomorrow at 11 a.m. Eastern. And as always, please keep an eye on your inbox for alerts. Thanks and have a good day trading.